Welcome to the deep dive. Today we're tackling a really crucial pair of safety nets, home and health insurance, specifically how they work here in Canada. We've got quite a bit of information to really unpack what you need to know about protecting your property and, well, your well-being.
That's right. And while home insurance isn't something you legally have to have, it's, a cornerstone of financial security for homeowners. It safeguards not just the building, if you own it, but also all the important stuff inside.
And on the health side,
On the health front, yeah, we'll be navigating the foundation of our healthcare system, the Canada Health Act. We'll explore how the provincial health plans work and also how they interact with private medical insurance options.
okay, so the goal here is to really boil down the essentials for you, our listeners, right? Make these complex insurance types understandable without getting lost in the weeds.
Exactly. Clear, comprehensive, but not overwhelming.
Great. Let's dive into home insurance first then. It's not just a single thing, is it? Seems like there are different kinds of policies.
That's right, yeah. Home insurance policies usually come in these bundled packages. They offer different levels of protection. So at the top end, you've got comprehensive policies.
Comprehensive. Sounds like it covers a lot.
It does. Think of it as the most inclusive option. It covers your house and everything inside against pretty much all risks, except for things specifically listed as exclusions in the policy itself.
Okay, so unless they spell it out as not covered, you're generally good.
Generally, yes, it offers, broad coverage.
Yep.
And because of that, it usually comes with a higher premium. More protection means a bit more cost.
Makes sense. So that's the high end. What about the other options? I see notes about basic or named perils.
Right, the basic or named perils policy. This one's much more limited.
Yep.
Like the name says, it only covers losses from perils that are specifically named in your policy document.
So it's not on the list.
If it's not on the list, you're not covered. Simple as that. It's typically less expensive, which is appealing, but you really need to read that list carefully. Make sure the things you're worried about are actually named.
Definitely sounds like homework is required there. Okay, what else? Is there something in between?
There is, yeah, the broad policy. This is kind of a middle ground. It gives you that comprehensive all-risk coverage for the actual building, the structure itself.
Okay, so the house itself is well covered.
Right. But then for your personal contents, your furniture, electronics, clothes, all that stuff, it flips back to a named perils approach. So your belongings are only covered for the specific risks listed.
Huh. That's an interesting mix. Full protection for the structure, but limited for the contents. Makes you think about what's more likely to get damaged, I guess.
It does. And then briefly, there's the no frills policy. It's less common, offers really minimal coverage, cheapest option usually, but very limited protection, maybe only right in very specific situations.
So just to recap the costs generally, no frills is lowest, then basic name perils, then broad, and comprehensive is typically the highest premium.
That's the general trend, yes. More coverage, higher premium. It's all about the level of risk the insurer is taking on. Standard insurance principle, really.
Got it. Okay, now let's shift gears slightly. What happens when you actually need to make a claim? There's this important choice about how you get paid back. Replacement cost versus actual cash value. Big difference here.
Oh, absolutely. This is a really key decision. Replacement cost coverage means basically if you have a covered loss, the insurance pays the cost to replace the lost or damaged item with a new one of similar kind and quality.
Without docking pay for age or wear and tear.
Exactly. No deduction for depreciation. So let's say your 5-year-old TV gets zapped in a power surge and it's covered. Replacement cost aims to give you the money to buy a comparable new TV.
Okay.
One important point, though, often you actually have to go out and repair or replace the item first to get the full replacement cost amount back from the insurer.
Ah, okay, so they want proof you actually replaced it. Now, how does actual cash value work then? It sounds like the less generous option.
It generally is, yes. Actual cash value, or ACV, does factor in depreciation. They look at the damaged items, say that 5-year-old TV again, and figure out what its market value was right before it was damaged, considering its age, its condition.
So what it was worth used, basically.
Pretty much. So for that 5-year-old TV, the ACV payout would likely be quite a bit less than what you'd need to buy a brand new one.
Yeah, that couch example we talked about earlier really hits at home. A 10-year-old couch, replacement cost gets you a new similar couch. ACV gets you maybe garage sale money for it.
That's a good way to put it. It's a significant difference, especially for older items. You need to weigh that when choosing your policy.
Definitely. So, okay, disaster strikes, something's damaged. What are the first steps for making a claim?
First thing, always contact your insurance provider as soon as possible, once it's safe, of course.
Yeah.
Let them know what happened.
Get the ball rolling.
Exactly. And if it involves a crime, burglary, theft, vandalism, you absolutely need to call the police too. Get a police report filed, get that case number. Your insurer will almost certainly need it.
Right, the official documentation. Now, there is this term, subrogation. Sounds kind of legalistic. What's that about?
It is a legal term, yeah. Subrogation, in simple terms, happens when your insurance company pays your claim for damage that was actually caused by someone else, a third party. After they pay you, the insurance company gets the right to go after that third party to try and recover the money they paid out. They essentially step into your shoes legally.
Okay, can you give an example? Make it clear.
Sure. Let's use that falling tree scenario.
Yeah.
Imagine your neighbor has a clearly dead, unstable tree right near your property line. You've asked them to deal with it, but they haven't.
Uh-huh.
Then a storm comes, the tree falls, smashes your garage roof. You file a claim. Your insurance pays to fix the roof. Because the neighbor was arguably negligent in not removing that hazardous tree, your insurer might then use subrogation to sue your neighbor to get back the money they paid you for the roof repair.
Ah, so the insurance company tries to recoup their payout from the person actually responsible. That makes sense. Okay, another benefit mentioned is additional living expenses. What does that cover?
This is a really important one. Additional living expenses, or ALE, helps you out if a covered peril like a fire or major water damage makes your home unlivable for a time.
So you can't stay there while it's being fixed.
Exactly. ALE covers the extra costs you incur because you're displaced. Things like hotel bills or renting a temporary apartment, maybe increased food costs if you don't have a kitchen, laundry expenses, that sort of thing. Costs above and beyond your normal living expenses.
That sounds like a huge relief if you're forced out of your home. Helps maintain some normalcy. Now, are there things home insurance typically doesn't cover? These
Right.
uninsurable perils?
Yes, definitely. Home insurance is mainly for sudden, accidental, unpredictable events. Things that happen gradually or because of lack of maintenance are often excluded.
Like what?
Well, damage from pests, insects like termites, or rodents like mice that's often not covered. The view is that's a maintenance issue you can prevent. Same goes for things like mold developing slowly over time or gradual water seepage.
Okay, so preventable stuff is generally on you, the homeowner. What about floods? That's often mentioned.
Floods are a big one. Historically, overland siding wasn't covered by standard policies, though specific flood insurance is becoming more available now, often as an add-on. But yeah, damage seen as preventable or resulting from wear and tear is usually excluded. Insurers focus on the unpredictable.
Makes sense from their risk perspective. Okay, let's talk liability coverage. This is part of most homeowner policies too, right? What does it protect you from?
It does. Liability coverage protects you financially if you or someone living in your house unintentionally injure someone else or damage their property, and you're found legally responsible.
So if someone slips on my icy walkway.
Exactly. Or if, say, your kid accidentally hits a baseball through the neighbor's window, your liability coverage can help pay for their medical bills or the window repair, plus potentially your legal defense costs if they sue you.
And it was interesting that this often doesn't have a deductible and can cover things like using your ride-on mower.
Yeah, often no deductible for liability claims, which is nice. And the coverage can extend to certain activities, like operating small boats or snowblowers. It's broader than just incidents right on your property line sometimes.
So that delivery person slipping example is a classic case where liability would kick in.
Absolutely. Now, if you're worried that the liability limit on your standard policy isn't high enough, maybe you have significant assets to protect. You can look into excess liability coverage. It's often called an umbrella policy.
An umbrella policy. Why umbrella?
Because it sits over your existing policies, like home and auto, and provides an extra layer of liability protection above those limits, like a big umbrella covering everything.
Got it. An extra safety net for major claims. Okay, before we jump to health insurance, just a few other quick mentions on the home front. Cottages, tenants.
Right. If you have a cottage or a seasonal place, sometimes it's covered under your main policy, but often you need a separate policy designed for those specific risks, like being vacant for periods. For renters, tenant insurance is key. It covers your own belongings against things like fire or theft, and your liability if you accidentally damage the unit you're renting.
And it can cover improvements a tenant makes too.
Sometimes, yeah. Often called a tenant's package.
Yeah.
And then there's condominium insurance. We didn't get details, but it's a specific type for condo owners, covering their unit, belongings, liability, and upgrades, working alongside the condo corporation's main insurance.
Okay, that's a really thorough look at home insurance. Let's switch over now to health insurance in Canada. This is obviously huge, underpinned by federal law, the Canada Health Act.
It really is the foundation. The Canada Health Act is federal legislation, and it sets out the principles and conditions that the provinces and territories have to follow for their health insurance plans if they want to get their full federal funding contribution. That funding comes through something called the Canada Health and Social Transfer, or CHST.
So the feds provide money, but the provinces have to meet these certain standards set out in the Act.
That's the basic idea, yes. It ensures a level of consistency and access across the country, and it has roots going way back.
To Saskatchewan, I believe.
That's right. Saskatchewan was the pioneer back in 1947 with the first provincial hospital insurance plan. Other provinces followed, and by 1961, all provinces and territories had public hospital plans. Physician services came later. The Canada Health Act itself was passed in 1984, bringing these existing principles together into one national law.
And the main goal was universal access, right?
Exactly. Universal access to medically necessary healthcare services for all eligible residents. That's the core objective.
And to make sure that happens, the Act lays out 5 key criteria. Let's walk through those. First is public administration.
Okay. Public administration means the provincial or territorial health plan has to be run by a public authority on a nonprofit basis. It has to be accountable to the government, not run for profit. Think of it like keeping the focus squarely on patient care.
Makes sense.
Yeah.
Second is comprehensiveness. What services have to be covered?
Comprehensiveness means the plans must cover all insured health services, which are medically necessary services provided by hospitals, doctors, and also surgical dental work done in a hospital. This includes things like hospital stays and standard rooms, nursing care, diagnostic tests like x-rays and lab work, operating rooms, anesthetics, the essential medical stuff.
Okay. Essential services. Third is universality. What does that guarantee?
Universality guarantees that all insured residents of a province or territory are entitled to receive the insured health services on uniform terms and conditions. Basically, everyone eligible gets the same access to the core services, regardless of income or status.
Fair access for everyone. Fourth criterion, portability. How does that work for Canadians moving or traveling?
Portability is crucial. It means your health coverage is maintained if you move between provinces or territories. There might be a brief waiting period for the new province's plan, but your old one covers you in the meantime. It also provides some coverage if you travel within Canada or, importantly, if you travel outside Canada, though that coverage abroad is usually limited to emergencies and paid at your home province's rates.
We'll come back to that out-of-country part, I bet. And the fifth criterion is accessibility. This sounds key.
It is. Accessibility means people must have reasonable access to hospital and physician services without financial barriers. So no user fees for medically necessary services, no extra billing by doctors above the provincial plan rate. Access should be based on need, not ability to pay. It also prohibits discrimination based on age, health status, etc.
Okay, so those 5 principles, public administration, comprehensiveness, universality, portability, and accessibility, they really define our public healthcare system. But you mentioned the provinces run the plans day to day, and they can differ.
That's right. While they all have to meet those 5 Canada Health Act criteria, the provincial health insurance plans have a lot of flexibility in exactly which additional services they cover beyond the core requirements and how they organize and fund things.
So the Act defines the core insured healthcare services, the necessary hospital and doctor stuff.
Yes, exactly. Inpatient, outpatient care, diagnostics, surgeries for us, the essentials.
But provinces might choose to add more, like other healthcare services.
They can, yes. Ambulance services are a common example where coverage varies a lot. Some provinces cover it fully, others partially, some hardly at all under the public plan. They can also choose to cover things like physiotherapy or certain drug programs, but they don't have to under the Act.
And things deemed not medically necessary.
Those don't have to be covered. Things like purely cosmetic procedures, for instance.
Yeah.
And eligibility is based on being an eligible resident of that province or territory.
Right. Now, let's touch on the money side again. Taxation implications. How does funding affect taxes?
Okay, so if a province uses a specific provincial health tax paid by employers, that's usually a business expense for the employer and not a taxable benefit for the employee.
Okay.
But if a province charges direct premiums to residents, well, if you pay that premium yourself, you generally can't deduct it or get a tax credit for it. However, If your employer pays that provincial premium for you,
Then it is a taxable benefit.
then yes, it's generally considered a taxable benefit and gets added to your income for tax purposes. It's treated differently than employer-paid private plan premiums.
Ah, an important distinction. Okay, so that's the public system. But Canada also has a big private medical insurance sector, often called supplementary insurance. How does that fit in?
It fits in by filling the gaps, essentially. Private insurance picks up where the public provincial plans leave off. Canadian law actually prevents private insurers from covering services that are already fully covered by the public plans.
So they can't duplicate coverage for, say, a doctor's visit.
Generally, no.
Got
But they can cover things the public plans don't cover or only partially cover, like the cost difference for a private hospital room instead of a standard ward room.
Okay, so what kind of things does extended health coverage typically include?
Extended health often covers prescription drugs. That's a big one, as public drug coverage varies widely. It can also include semi-private or private hospital rooms, emergency medical costs when you're outside Canada, and paramedical services.
Paramedical, like chiropractors, physio.
Exactly. Chiropractors, physiotherapists, massage therapists, optometrists, psychologists, those sorts of practitioners. Plus, vision care eye exams, glasses, contacts, and things like hearing aids are often part of extended health plans.
And dental insurance coverage is usually private too, right? Public plans don't cover much dental for adults.
Very little, typically. So yes, private dental insurance is very common. Plans vary, but usually cover things like basic preventative care checkups, cleanings, fillings, basic extractions. Then there are major services, crowns, bridges, dentures, and orthodontics, like braces, often with limits.
And the cost and coverage depend on the plan design. Things like deductibles, co-insurance. Can you explain those quickly?
Sure. The deductible is the amount you pay out of pocket each year before the insurance starts paying. So maybe the first $100 to $250 of dental bills are on you.
Okay.
Coinsurance is the percentage split after the deductible. A common split is 80-20, meaning the insurer pays 80% of the eligible cost and you pay the remaining 20%.
Got it. And there are usually maximums?
Yes, limits on how much the plan will pay. Could be an annual maximum per person for, say, prescription drugs, or a lifetime maximum for something like orthodontics.
And who picks these amounts? Deductibles? Co-insurance?
In group plans through work, the employer often selects the deductible and co-insurance levels. The insurance carriers usually set the maximums based on the plan design.
Okay. Now back to that out-of-Canada coverage. You said provincial plans offer limited coverage abroad. How does private insurance help there?
This is super important for travelers. Provincial plans might pay the equivalent of what the service costs back home, in Canadian dollars, for emergencies only. But medical costs elsewhere, especially the U.S., can be vastly higher.
So you could be left with a huge bill.
Potentially, yes. Private out-of-country travel insurance, often part of extended health plans, is designed to cover those much higher costs for medical emergencies abroad. But you really need to check the details.
Like what details?
Things like the maximum number of days per trip covered. Maybe it's only 30 or 60 days. Pre-existing condition clauses are critical. Will they cover an emergency related to a condition you already had? And the overall coverage limit, assuming your group plan covers everything perfectly, is a common and sometimes very expensive mistake.
Definitely sounds like something to verify before you travel. Okay, last point. Taxation implications for private health insurance. How does that work?
This is generally favorable. If your employer pays the premiums for your private health and dental plan, it's a tax-deductible expense for the employer. And, crucially, those employer-paid premiums are not usually considered a taxable benefit for you, the employee. You don't pay income tax on the value of that premium.
That's a nice perk.
It is. And furthermore, when you actually receive benefits under the plan, like getting reimbursed for drug costs or dental work, those benefit payments are also received tax-free. They aren't added to your income.
So tax-free premiums paid by the employer and tax-free benefits received. That's quite advantageous.
It really is, compared to paying for those services entirely out of pocket with after-tax dollars.
Wow, okay. That brings us through a pretty detailed look at both home and health insurance in Canada. We've covered a ton, from the different home policy types like comprehensive versus named perils, replacement cost versus actual cash value, claims, liability,
right through to the foundations of Canadian healthcare, with the Canada Health Act principles, how provincial plans work, and where private insurance fits in to cover things like drugs, dental, and travel emergencies.
It definitely paints a clearer picture of these really essential protections. Understanding the home insurance options, the levels of coverage, how you're reimbursed, the liability aspect is just so important for tailoring it to what you actually need.
Absolutely. And on the health side, knowing the 5 pillars of the Act, what your provincial plan likely covers and what it doesn't, helps you see the value and necessity of supplementary private insurance for things like dental, vision, prescriptions, especially if you travel.
It's all about understanding the interplay between these systems to make sure you're properly covered.
Exactly. It empowers you to protect yourself financially and access the care you might need.
So here's something for you, our listeners, to maybe think about. Considering the differences between provincial health plans, the huge variety in private insurance options, and the different tiers of home insurance, how can you best figure out your total insurance picture? How do you make sure you have comprehensive protection across the board without paying for unnecessary overlaps, but also without leaving any really critical gaps unplugged? Something to mull over as you look at your own policies. Thanks for joining us for this deep dive.